Near record week on Wall Street, inflation is still warm, the consumer keeps the pace, and a Buffett move jolted healthcare, while sentiment cracked among chip equipment makers. The weekly message was about both the macro picture and sentiment. July inflation painted a mixed picture. The headline gauge remains in the uncomfortable range, core is sticky, but overall not so hot that the market would throw away the September easing narrative. Bond yields fluctuated, yet in equities the baseline remained risk-on. Sources: BLS, main CPI report July, major U.S. wire summaries AP, WSJ, Reuters. The consumer didn't tire. Monthly growth in retail sales and in the control group component lent support to the soft landing scenario. This fed directly into the U.S. market. Discretionary and services segments picked up momentum. Sources: U.S. Census retail sales, Reuters quick take. A single corporate move visibly shifted index dynamics. Berkshire Hathaway announced it had bought several million UnitedHealth shares. The stock jumped by double digits and the Dow hit a new intraday high, a classic value print that broadens the rally beyond megatech. A duality emerged in technology, mention only. Demand for networking AI infrastructure remained strong. For example, Cisco, while a more cautious outlook appeared among chip equipment makers, for example, Applied Materials. I unpack the details below in the earnings section. Sources: company communications, major outlets weekly reviews. China automatic block. Among the big e-commerce names, one flagship JD.com showed strong revenue growth. This feeds back to the US via ADR sentiment and supply chain expectations. By week's end, all three major indices closed higher. The Dow's performance stood out through the healthcare sector, while the S&P and Nasdaq showed a pattern of broadening gains. This rotation neatly rhymes with the inflation consumer trade policy triangle. Alongside growth, defensive and cyclical baskets are also taking turns at the front. Technology, networking and AI infrastructure, Cisco. With a healthy but not euphoric quarter, Cisco signaled that AI networking capex is already landing in real order books. Quarterly revenue roughly $14.7 billion, adjusted EPS about 0.99. During fiscal 2025, AI infrastructure orders from web-scale customers topped $2 billion, of which approximately $800 million came in the latest quarter. Semiconductor equipment, Applied Materials. The company reported a strong quarter but guided next quarter revenue to approximately $6.7 billion below consensus. Rationale: weakening Chinese demand and export license uncertainty. The stock fell by double digits and dragged down the equipment group. Industrials, Deere. Deere's profit fell while the full-year net income target was narrowed to a $4.75–5.25 billion range. The narrative: softer end-market demand, rising input costs due to tariffs, weakening pricing power. Consumer entertainment theaters, AMC Entertainment. AMC's revenue rose to approximately $1.4 billion. Attendance grew by 26%. EBITDA improved meaningfully. Net income hovered near zero. Chinese internet, JD.com with U.S. impact. In the second quarter, JD delivered about 356.7 billion yuan of revenue, plus 22% year-over-year. Southeast Asian platform, C Limited with U.S. impact. Group revenue approximately $5.3 billion, plus 38% year-over-year. Net profit $414 million. Shopee Digital Financial Services and Garena pulled together. This was a week of near-record normalization. Inflation stayed within a manageable band, the consumer held up the economy, and along the way it became clear that the true bottleneck of the AI era is the networking data center backbone. While China exposure is currently the weak spot for equipment makers, my question to you: do you think the September Fed meeting will deliver an actual cut, or will we get another wait-and-see round? And if it's a cut, will quality value healthcare industrials or second-tier AI growth benefit more? Disclaimer: this video was made with the help of artificial intelligence and does not constitute financial advice. I have not changed my strategy. Disciplined risk management remains the top priority. If the total value of my portfolio increases by approximately 5% compared to the current level, I will very likely close all positions. I'm not risking it for the last few percent. I take profits first, protect capital, and then patiently wait for the next clear entry signal. This is not a directional bet on the market, but a pre-committed exit discipline. So let's see how the three strategies have evolved. Strategy 1. Lump sum, one-time investment, blue line on the chart. The first investor bought an S&P 500 ETF on January 2, 2025, investing the entire $15,000 at once. They've held the position ever since. No additions, no withdrawals, current performance year-to-date, 66%. The blue line reflects this result, based on the most recent Friday closing price. Strategy 2, dollar cost averaging, gradual investment, green line on the chart. The second investor splits the $15,000 into 12 equal parts, investing $1,250 on the second trading day of each month. This approach helps smooth out volatility and reduces the risk of poor entry timing. Current performance year-to-date, 10–25%. The green line reflects this strategy, slightly outperforming the lump sum method so far. Strategy 3, my fictional portfolio, red line on the chart. This portfolio is based on my own stock picks and investment decisions. It launched on March 19, 2025, with the full $15,000 invested in various individual stocks. I've explained my choices in earlier videos. Current performance year-to-date, 34–48%. Note, these performance metrics exclude broker fees and taxes. They reflect only market-based price movements. Thank you for joining us on this economic journey with Test Portfolio XSX. If you enjoyed this weekly recap of the key events and our portfolio's performance, give it a like, subscribe, and join us again next week as we review the latest market moves and the progress of our investments. Disclaimer: this video does not constitute financial advice and does not recommend the purchase or sale of any financial instruments. I do not take responsibility for any potential inaccuracies or errors that may occur.